Two houses burned down in California, same January week, same neighborhood, same square footage, same black foundation by Tuesday morning. The first family makes about $85,000 a year. They call their insurer. 2 weeks later, an adjuster shows up. 3 months after that, a partial check. Then a depreciation dispute over a 14-year-old roof. And then a letter. The California Insurance Commissioner later investigates. The exact phrase? Delayed, underpaid, and buried policyholders in red tape at the worst moment of their lives. 398 alleged violations. The second family, household net worth around $6 million. They call their insurer, too. A dedicated adjuster shows up the next morning. Within weeks, cash settlement up to policy limits. No fight over the roof, no non-renewal letter. Same fire, same state, same week, two completely different industries wearing the same logo. And this is not a story about fire insurance. This is a story about what happens when one product gets sold 4 different ways to 4 different people and you don't even know which version you bought. Let's start at the bottom. I want you to meet Maria. She's not a real person, but she's not made up either. She's a composite of about 30 million Americans. Maria is 34, single mother of 2, takes home about $35,000 a year. Her credit score is 612 because she had a medical episode in 2021 and she's still digging out. Never had a car accident in her life. Now watch what happens. When Maria tries to insure her 2014 Camry, the insurance company checks her credit score. In most states, they are legally allowed to charge you more for car insurance based on how you pay your credit cards. And the math is vicious. Drivers with poor credit pay 115% more than drivers with excellent credit. Same car, same 0 accidents, twice the price. Your credit score was invented to predict whether you'll repay a loan. It is now used to predict whether you'll crash a car. The scientific connection between those two things, 0. The connection to your premium, about $1,200 a year. But here's the part nobody tells you. It gets weirder. They also charge Maria more because of her job. An investigation found that Geico would quote a factory worker without a college degree 91% more than an attorney with the same driving record. Same driver. Same record. Different job title. Different price. They charge her more because she rents. They charge her more because of her zip code. A 2017 investigation found insurers charging up to 30% more in minority neighborhoods than white neighborhoods. Same claim payouts. The risk was identical. The bill wasn't. And there's a special bonus charge. Maria couldn't afford insurance for 2 months last year when rent went up. So now there's a surcharge for having a coverage lapse. They are literally charging her a fee for once being too poor to afford them. That's not a policy. That's a penalty for breathing while broke. Pay attention to this. Maria doesn't qualify for the good rates. She ends up at a company you've seen on a billboard near a check cashing place. The generals, the acceptances. This is the non-standard market. It functions roughly the way payday lending functions, but for liability coverage. State minimum liability, the cheapest, weakest version of insurance that legally lets you drive, runs Maria about $280 a month. Her Camry is worth maybe $4,000. She is paying premium money for minimum protection on a vehicle worth less than her annual premium. Maria isn't insured, she's just legally allowed to drive. But wait, it gets worse. We haven't done health insurance yet. Maria's bronze ACA plan has a $7,500 deductible, which means until she pays $7,500 out of pocket, the insurance does not actually do anything. She has insurance, the noun. She does not have insurance, the verb. She has a card and a prayer. And then there's life insurance, because the predators aren't done yet. There's an active class action lawsuit alleging a major company sold tiny burial policies to elderly buyers, asked vague health questions, and then, when grandma dies, conducted an exhaustive review of her entire medical history, found some unrelated condition, neuropathy, mild hypertension, and rescinded the policy. So grandma paid premiums for years. The family gets a sympathy card and a refund check. And somewhere a shareholder is delighted. Let's climb. You make somewhere around $80,000 a year. You drive something reasonable. You have a 401k. You contribute about 6%, which everyone told you is responsible. You have health insurance through work. Every 6 months, your auto renewal notice comes, and the number is a little higher. You don't quite know why. You don't have the energy to fight it. Welcome to the middle tier. And here's the twist. This is the most dangerous one. Not because it's the most expensive. Because it's the tier where the system is most efficient at quietly extracting money from you while making you feel taken care of. You have just enough assets to be worth suing and not enough to actually protect yourself. Here's a number nobody puts on a billboard. If your teenager rear-ends someone on the highway and that person gets seriously injured, modern jury awards for personal injury frequently exceed $2 million. Your standard auto liability tops out at $300,000. Your homeowner's liability maxes at maybe $500,000. Plaintiff's attorneys literally pull your net worth before deciding whether to sue you, and you, my friend, are the perfect target. The fix costs roughly $200. An umbrella policy gives you another million in coverage for about $200 to $400 a year. The same insurance company that mails you a calendar every December has never once aggressively called you to sell an umbrella. They mailed you the calendar, though, because the umbrella is one of the rare insurance products that's almost certainly worth the money for you, which is precisely why it is not the priority for them. No, what they will sell you is whole life insurance. A healthy 35-year-old can buy a 20-year term life policy, $500,000 death benefit, for about $25 to $35 a month. The same death benefit in whole life costs somewhere between $500 and $700 a month. That's roughly 15 to 20 times more. Stay with me. And that markup exists because the agent's first-year commission on a whole life policy can run 70 to 110% of your first year's premium. The agent isn't lying to you. They're simply being paid an extraordinary amount of money to nudge you in a specific direction. If someone offered you a year's salary to sell someone a product, you'd probably nudge too. And then there's health insurance at this income. You have prior authorization. The polite industry term for the insurance company gets to decide whether you can have the treatment your doctor just ordered. One major insurer uses a review algorithm so fast that denial decisions were issued at a rate of roughly 1 every 1.2 seconds. A former company doctor described it like this: "We literally click and submit." And then, in late 2024, the CEO of United Healthcare lost his life in a highly publicized incident. When the company posted condolences online, the post received roughly 100,000 laughing emojis. 100,000. That's not Twitter. That's a polling number. That is a real, undeniable metric of how public sentiment in this country feels about the human cost of health insurance denials. Let's keep climbing. You're now making $150,000 to $300,000. Senior engineer, partner track lawyer, dual physician household. You have a real house. You have actual investments. Your credit is excellent. Your zip code is desirable. Your car is newer. Suddenly, insurance starts being polite to you. Multi-policy discounts. Real PPO with a real network. You can see specialists without rehearsing a speech to the front desk about why your referral is taking so long. This is the tier where it stops feeling like a fight and starts feeling like a service. But here's the rehook. This is also the tier where the most elaborate sales operations live. You get pitched concierge medicine, $2,000 to $5,000 a year, same doctor, same medical license, but now they actually have time for you. It is a real service. It is also, functionally, a tax on the upper middle class for the privilege of being treated like a human inside a system that already takes your premium dollars. You also get pitched something called an IUL, Indexed Universal Life, whole life on steroids. Marketed as tax-free retirement magic using the stock market, but with caps, usually 8 to 12%, with floors, 0%, and with fees that can only be described as creative. For some buyers, the math works. For most, the math doesn't, but the commission absolutely does for someone else. And here's the thing. This is finally the tier where someone says the word umbrella out loud to you. Usually a wealth advisor who's annoyed that nobody mentioned it sooner. You get a $2 million umbrella for like $300, and you wonder, why did nobody mention this years ago? Nobody mentioned this years ago because you weren't worth the conversation yet. One more rung, net worth above $5 million, income north of $750,000. The official term is high net worth, which is itself a polite way of saying the customer the insurance industry actually likes. Welcome to the version of insurance that exists in brochures. The one the rest of us thought we were buying. At this tier, you don't buy homeowners insurance from the brand on the billboard. You buy from Chubb, AIG Private Client, PUER, names that don't advertise during football games because they don't need to. Your policy doesn't pay replacement cost, it pays guaranteed replacement cost. If your $3 million home burns down and construction costs spiked 40% because every other house on the street also burned, the policy still rebuilds it. And this part sounds invented. Most of these policies include a cash settlement option. Your house burns down, you can just take the check up to policy limits and walk away. No rebuild required. Buy a different house, move to another state, retire. That option does not exist on your aunt's State Farm policy. It just doesn't. When you make a claim at this tier, you don't get a 1-800 number. You get an adjuster's cell phone. The carrier sometimes sends out a guy with an infrared scanner before any disaster happens, just to make sure your house is safe. Your auto insurance covers the Range Rover, the boat, the kids' cars, and an umbrella that runs $50 million in liability. Because at this point, another $5 million in coverage costs roughly the same as a nice dinner. Your health insurance is whatever you want it to be. Concierge doctor texts you back at 11 p.m. There's a service called MD Squared that charges around $24,000 a year. Your doctor's patient panel is 50 families. 50, not 5,000, 50. And the wealthy don't argue with prior authorization. If their doctor recommends something, they just pay cash. They have stopped using health insurance the way regular people use it and started using it the way corporations use it. A backstop for events they hope never happen. Life insurance at this tier is not life insurance. It's a tax product wrapped in a death benefit. A 2024 Senate investigation estimated one specific high-end version was being used to shelter up to $40 billion from inheritance taxes. Same two words on the policy, life insurance, completely different product than what gets sold to grandma at the kitchen table. Now zoom all the way out, the same industry, the same year, will quote Maria $280 a month for state minimum liability on a 14-year-old Camry, and quote a tech executive $280 a month for full coverage on a Tesla. Same premium, two completely different products. We'll sell grandma a $10,000 burial policy and then exhaustively review her medical history to deny it after she dies. And sell a hedge fund manager a $20 million policy that's functionally an estate tax loophole. We'll deny a cardiac procedure to one patient via algorithm and assign another patient an adjuster with a personal cell phone number. In 2024, the property and casualty insurance industry posted around $170 billion in net income, the largest underwriting gain in 4 years. The CEO of Allstate took home roughly $26 million. The industry spent over $100 million on federal lobbying. And the people getting denied, dropped, surcharged, non-renewed, and rescinded were almost entirely in the bottom two tiers. This is not one industry. This is a sorting machine. Here's what you can actually do about it. Shop your auto insurance every 2 years instead of letting it auto-renew. Loyalty is structurally a tax in this industry. Stop buying whole life policies sold at a kitchen table by someone whose commission depends on your signature. Buy that boring $300 umbrella the day your net worth crosses into the worth suing zone. And read your homeowner's policy. Find out whether it pays replacement cost or actual cash value on your roof. That one sentence matters more than almost anything else in the document. But here's the only really useful thing I know. Insurance is not a relationship. It is a contract. They don't love you. They never did. The wealthy figured that out a long time ago and built their entire approach around it. They treat insurance like the cold, adversarial, transactional product it actually is, and they buy accordingly. The rest of us treat it like a service from a friendly company with a mascot, and we get treated accordingly. 3 things. 1. The math is undeniable. Same fire, same street. 2 different industries under one logo. 2. You don't need to be wealthy to buy insurance like wealthy people. You need to understand which product actually protects you and which product just bills you. 3. Every month you let your insurance auto-renew without checking. Every whole life policy you sign at a kitchen table. Every year you skip the $300 umbrella, you're not saving money, you're paying a premium to stay in a lower tier of protection that a system designed specifically to keep you there. Remember the 2 houses we started with? Same neighborhood, same fire, 2 different industries. The difference between them wasn't luck. It wasn't even fundamentally money. It was knowing early which industry you were actually buying from. I'll see you in the next one. Which of these facts made you the angriest? The credit score surcharge, the 70% agent commission, or the 1.2-second algorithm denial? Drop it in the comments. I actually want to know. And if this made you uncomfortable, like, subscribe, and send it to someone who's been paying their renewal notice without asking why.